Peter Lynch used to talk about buying the things that you see happening. There's in the shopping center, there's a new store, and they're getting a lot of traffic or whatever. And Peter had an unusual. Do you all know who Peter Lynch is? He had a really unusual talent. He had 1,200 securities in the Fidelity Magellan Fund. He ran it for 8 or 9 years and had a phenomenal record and so on. But he had 1,200 securities. I mean, imagine. So I was in seeing him one day, and what he would do, we were talking about this earlier, is if he found an industry that he liked, or he would buy every company in that industry, put them in his portfolio, and then he'd eliminate them one at a time as he kept honing in on who were the best ones and so on.
Don't forget to like and subscribe if you haven't done it already.
It's another case where we made 10 to 20 times our money in our accounts. Again, this was a situation of high returns on capital, low valuation, major shareholder, owner, and operator, and a low valuation with a huge opportunity for growth going forward. And then in current times, we talked a little bit about MasterCard. Some things that are interesting about MasterCard. We purchased it originally in February of 2010, and this is when the Dodd-Frank discussions were going on in Congress after the financial crisis, and more particularly about the Durbin Amendment, which had to do with domestic debit transactions. The long and short of it is, we bought the stock at an average price of $22.20 in February of 2010. Today it's 109, something like that. So we made 5 times our money in 6 years, something like that. And the reason was that here's a business that had fantastic returns, as we've already talked about. It had a low valuation. The valuation in February of 2010 was something like 13 or 14 times. It was growing its free cash flow per share at a rate much faster than that. And we had a good thing happen with it, that we've been to meet the new CEO, Ajay Banga, who's a Punjabi, and really bright, interesting, lovely guy. And so you and I were talking earlier about the interaction of people. And so we see him in a setting with other executives in his firm, and he's first name basis, kidding with them, they kid with him. All of these things are important, just things, I talked about reading business biography. You get a feel for how people behave and how they deal with their colleagues and so on. And so we've made 5 times our money in 6 short years in an extraordinary business. Now, if you remember what I talked about, the third leg, reinvestment, their returns are so high that they can't possibly find another place to reinvest their money at that rate and get that return. So our compounding is diminished modestly because of that. So they buy in scads of stock, they pay a dividend, they invest a lot in new technologies, all relating to what I call the electronic exchange of value. I mean, that's really the business they're in, and we don't know what form factor it will take in years, but they're well positioned in all of the things that are going on today. Another company that is relatively new to us is Moody's, and we bought our Moody's originally in January of 2012, and we paid about $39, a little less than $39 for it. Today it's $110, and so we have a case where we've made 2.5, 2 3/4 times our money. Again, the same idea. A great business. After Dodd-Frank, the government authorized another 6 or 8 rating agencies to exist. I'm sure there's not a person in this room who can tell you the name of any of them. It's a market-driven thing. It's not regulatory-driven. And so any company that issues debt has to go out and get a rating on it. And there are really 3 rating agencies, Moody's, S&P, and Fitch. The market is divided like 40%, 40%, and 20%. Fitch has had 20% for nearly 100 years. They just can't seem to grow it any larger than that, and it's market-driven. And if you sit on the board of a company that's about to raise debt, and you go out and you don't get a rating on your debt, and you have a bad effect in the market, you have a liability. So it's a fascinating business that again, market forces allow it to have very high returns on its capital. Another company that we've been involved with for, almost 10 years is a company called N-Star. And I sat on their board for 5 years because I wanted to try to understand how the business really operated. And it's a complicated business. They buy insurance which is in runoff. And that is, operating insurance companies periodically decide, well, we don't want to be in homeowners anymore. We don't want to be in long-haul trucking anymore, whatever. And they run that business off, and they're required to keep assets to support those liabilities by the regulators until that business is gone. And executives in businesses like insurance who have aspirations in their career would not like to be placed in the runoff. It's sort of the back room of the business. And this group of people who started this company are chartered accountants by training, and they're headquartered in South Africa and Dublin and Bermuda and London, and they travel all over the world all the time in search of trying to find these little pieces of business. I've seen instances where they worked on a piece of business for 5 or 6 years. They're very patient, very disciplined. And when I got involved in this company in 2007, it had a record of compounding book value per share a little bit north of 20%. But it was also 3 times book. And I paid $102.90 for my first shares in 2007. And today it's worth about $195. So it's not been a very good investment. And I've essentially doubled my money, but it's taken 10 years, so that number obviously roughly around 7% compounded. But then the valuation got more attractive periodically, and in 2009 I was able to buy some stock at 56. So my return there is nearly 4 times, and that sort of stuff. And so that goes back to this issue I was talking about, your starting valuation. And when I paid 3 times book for this company in 2007, and it had a history of compounding book at 20%. Had it been able to continue to compound at 20%, I would have done much better. But their rate of return has come down, just like it has in all businesses, as we've had this secular decline in interest rates for 36 years as a backdrop. Everybody's business returns are lower, nearly everybody. And you should make everything as simple as possible, but no simpler. You'll have to think about it a minute. The difference between stupidity and genius is that genius has its limits, We cannot solve our problems with the same thinking that we use to create them. The only source of knowledge is experience. Imagination is more important than knowledge. I told Surab, that's what it actually says on the front of my book. And the true test of intelligence is not knowledge, but imagination. So we put our own little quote on the end of that. It's an old saw, which says that good judgment comes from experience, and experience comes from bad judgment. So in conclusion, we work in a town with 1 traffic light. And I say it makes the decision process so much simpler. Einstein, make things as simple as possible. We tell people when they get to the light, turn, sooner or later they'll get to us in town. And what's really important is that in a campus like this, or in Central Park South in New York, or in downtown San Francisco or Los Angeles, we'd be surrounded by hundreds of people who were very bright and very interesting. And the reason we're in a town with 1 traffic light away from that is that their stuff would be intellectually appealing to us. And it would distract us from what it is we do well. And that's a really important notion. Warren talked about getting out of New York and going back to Omaha when he was a young man. It's the same idea. And not that being in your midst wouldn't be unbelievably fulfilling, or being in New York or something like that. It's that it distracts us from what we do well. And so that's a really important thing, is you're thinking about being an investor, is to create the situation for yourself that you have the ability to apply what it is that you've learned and found valuable in investing as opposed to listening to what Squawk Box or your next door neighbor or your suite mate says, something like that. Make things as simple as possible, but no simpler. Imagination is more important than knowledge, you know. So I would say simply use your own observations. It's very important. Peter Lynch used to talk about buying the things that you see happening. There's in the shopping center, there's a new store, and they're getting a lot of traffic or whatever. And Peter had an unusual. Do you all know who Peter Lynch is? He had a really unusual talent. He had 1,200 securities in the Fidelity Magellan Fund. He ran it for 8 or 9 years and had a phenomenal record and so on. But he had 1,200 securities. I mean, imagine. So I was in seeing him one day, and what he would do, we were talking about this earlier, is if he found an industry that he liked, or he would buy every company in that industry, put them in his portfolio, and then he'd eliminate them one at a time as he kept honing in on who were the best ones and so on. It's not a talent that I have. And then I say, just because you have a big brain doesn't mean you could be good at investing. And that's an important thing too. And finally, there is no correct answer. There is no correct way. This is just the way that works for us. I'm happy to have the opportunity to share these few thoughts with you.
Thank you guys for watching. I hope you enjoyed. Don't forget to hit the like button and to subscribe if you haven't done it already.